All right, cool. So welcome, Ryan. So for those of you who don't know who Ryan is, he started in 2004 as an agent, focused mainly on REO. He has sold over 7,500 properties, which is pretty astounding to me. I thought I was a high volume agent until I saw that here. He's also a top Remax agent by transactions every year. So Ryan Smith is the guy to tell us where the market's going this year, especially in regards to distressed properties. So Ryan, welcome. We'll keep this informal. Just tell us kind of what you think is going to be coming down the pike this year for those of us who.
I can't hear him.
Ryan, I think you're muted.
There you go.
There you go.
Everybody on the call is aware of what an REO is and what REO means and that whole background, I would assume, or no?
I would break it down for, we might have some people here that are newer. It'd be good for all of us to hear it, I think.
Yeah, so I'm a broker by trade and I specialize in the default industry. So I represent REO properties, is what they're known to on the market, but my clients are mortgage servicing companies, investment funds, GSE, government service entities such as Fannie and Freddie. And we represent their REO properties or the real estate owned assets throughout Chicagoland. We probably do about 40 to 50% of the REO default assets that come through Chicagoland area. We handle Cook, Will, DuPage, Lake, Kendall, some McHenry County, depending on where it's at. And basic of an REO is it's a real estate owned asset. So when a property goes into default, in Illinois, we have a judicial sale. The property goes to the judicial sale, at which point there's a reserve set, whatever be 100,000. And I don't know how many people are on pro bidder on here or bid at the sale, but you put a bid on in the sale. If nobody buys it, it reverts back to REO, which means it goes back to the bank that put it up for sale at the auction. And then it comes into our office and then we manage it for them. We sell it for them. We trash it out, sell it and get it on the market and sell it to investors or owner occupants and try to dispose of those type of assets. We've been doing it. Well, I've been doing it almost 20 years here in Chicago. We average 250 to 350 a year. The last year has been a little slow for us because the courts have been closed down. I guess that can bring us up to where we're going to go or where we feel we're going to go. Everybody says we're not going to have another 2008. And that's right, we're not. 2008 was a once in a lifetime, once in a decade type of correction. And we have it every year. I mean, you have the S&Ps of the 90s, the early 2000s, we had the default crisis, and there'll be another correction in time. In 2008, we saw at about a 5% default rate. And that's why we saw so much defaults. An average healthy market, you see about a 0.5 to 0.75% default rate, 1%. Prior to COVID, we were at a 1% default rate for about 3 to 4 years leading up to COVID in the Chicagoland market. Where do I think we're going to go? I think we're going to see about a 2.5 to 3% default rate. So not quite what we saw in 08, but double what we saw prior to COVID. And I think it's going to be a 3 to 5 year play for the Chicago markets. And when I say Chicago market, because you look at what's going on nationally with real estate, and we're seeing tremendous growth in Salt Lake City and the Western states, a lot in Arizona, a lot in Nevada, a lot in Texas, a lot in Florida. And those markets are different from Chicago. Chicago, Cook County, DuPage County is its own type of market. And we have factors that affect us differently than we do nationally. We have the largest FHA buyer pool in the country. We have the largest upside down market, meaning we have the largest amount of negative equity in homes in the Chicago market. We have more negative equity properties than LA, Miami, and New York combined. And we have property taxes that are rising at 6 to 8% annually. You combine FHA loans with limited equity in the property, combine an 8% property tax increase. At some point, the market has to correct. And where we're going to see a lot of that inventory is prior to COVID, we put a stop on default in March of 2020 or 20. How many years are we into this now, John?
Yeah, I
Um,
mean, we've been in this thing for 2 years, right? I imagine for you, it seems like 20, because I mean, you kind of
yeah.
make your living off of defaults, and then there haven't been any for a lot of that time.
So March of 2020, the entire state stopped foreclosures, and they stopped those foreclosures for up until September of 21. So about 18 months they stopped doing foreclosures. Prior to COVID in Cook County alone, we would see on average about 450 to 500 properties a month revert from the sale to REO. Now that's prior to COVID. All those properties were put on hold. Well, there was still a lot of default backlog, right? So we took away 4,000 to 5,000 properties annually from the marketplace. And we're starting to see those come through now. We're seeing about 1,500 properties a month go to sale now. About 400 to 600, about 550 on average are reverting back to REO since October. So we're going to start to see a backlog of what happened pre-COVID come out. I think the second wave of why we're going to be in a 3 to 5 year steady increase of defaults is because a lot of people during COVID lost their jobs, lost their income, and they didn't they didn't successfully exit the forbearance program. So that'll be the second wave of default that comes out of this. And then the third trickle will be a lot of people that are buying now and have bought since COVID are buying at the top of the market with FHA loans where there's limited equity in the property. And in Chicago, we're one of the few urban markets where FHA is still in a big house, a lending product, because FHA really lends up to 450, 500,000. And if you go to New York, San Francisco, Miami, or other major markets, you're going to have a hard time finding housing stock under 500,000. So we're still a large FHA market with limited equity in the game. And then you say, well, values are going to continue to rise, but you have to ask yourself, if you look at towns or neighborhoods that do not have a downtown structure, such as, if you look at Naperville, Lisle, Clarendon Hills, Western Springs, Northbrook, Skokie, a lot of these towns have a downtown area, right? They have a train, they have shopping, they have food options. You look in some of these towns, Belmont Cragen, Berwyn, where there's a strong bungalow housing product, 1920 style bungalow, 1,200, 1,500 square feet. How can those values continue to rise above $400,000, $500,000 if they're not the best rated schools? You don't have a big infrastructure downtown where you have train, where you have a community feel. Can a 1920s bungalow get to 650, 700,000? I think it has to correct at some point. And with interest rates rising, the treasury rate has risen consistently for the past year or so. And it's the first time in history that the interest rate hasn't followed the treasury rate. And the interest rate's starting to rise now. And with a point increase, if we get up to 4.4% interest rate, I think we'll see a 8 to 10% decline in values.
Ryan,
I think
I got a quick question for you. So a lot of our investors are newer, right? So you're talking about a 3 to 5 year window for some of these foreclosures, and you're talking about like maybe 2 or 3 years before some of them even hit the market, right?
No, I mean, we're starting to get a lot of them in now. So when we get them in from the sale, there's a 60-day confirmation period in Illinois. We're going to start to see an increase in listings on our end, probably by quarter two, quarter three of this year. And I think we'll see a gradual increase to steady off in the next I think we'll remain steady. By the third quarter of this year, we'll start to pick up. And then I think we'll see a moderate, steady flow of them for the next couple of years.
I'm curious because you probably have this stat more than me. Again, I do a lot of listing properties, but not REO. I'm just listing, regular properties. I feel like this has actually been missing in the market in general. REOs, short sales, any kind of distress. Do you feel like there's so much market demand that a lot of this will just get soaked right up by all the demand initially?
It may. We've seen a slowdown on. We're not getting multiple offers on as much stuff. We're pricing them a little more aggressively because of what the market's doing, and in some areas it's kind of slowing. We're having to bring it back down to, we're not getting the optimistic price points we thought we would. I think right now there's a lack of inventory out there. I think over the next few months, as the sales continue to happen, the inventory starts to come out, I think it'll level off slightly. inflation is going to be a big player in the supply and what gets gobbled up, right? If inflation continues to rise, I think values are going to continue to rise behind it because it's better to put money behind a hard asset. Even if the rates rise, I think inflation will balance that out.
That's such an interesting point. I mean, I was in college during the last crash of my graduate degree. I didn't have any money, so I couldn't buy, but I remember it being this amazing buying opportunity is what I remember thinking about as things were so cheap. But sounds like with the, limited inventory now and inflation, we're not going to see a dip. What you're saying is we might see a correction in a couple years, 2, 3 years on the overall pricing, especially for your kind of entry level buyer who's buying that $300,000-400,000 house.
Right.
FHA.
Yeah. Yeah. I think you'll see a slight dip on that. I think from an investor standpoint, I don't think you can worry. I know this is going to sound crazy. I don't think you can worry much about the values right now. Inflation is going to be at a 6 to 7% inflation for the next, some forecast 8 years, some forecast 5 years. Even if rates go up to 4.5%, hedge your money behind an asset, keep it as a rental. You're going to be better off fighting inflation by putting your money behind an asset than leaving it anywhere else.
So I want to kind of pivot this a little bit because I know a lot of our investors here are going to be frankly fascinated, and they're getting an opportunity to kind of see into the world you're in, which is a place that they're going to need to deal with. Let's say a newer investor is interested in buying the types of properties that you list. The people that you work for that tell you, hey, Ryan, sell this property. What are their goals? What are they trying to accomplish? Are they trying to get top dollar? Are they trying to just get it off their books? Like, how do you put together a winning deal?
That's a big, a big misconception on default assets as well. They owed 100,000, so I'll give them 150. At the end of the day, it's a business just like everything else, right? The bank's going to request fair market value for the property. We do price the properties. We provide what's called a broker's price opinion, which is pretty much an appraisal to the bank. And we do an in-depth market write-up and describe the house and provide them a video walkthrough so they see what they're looking at. In the old days in 08, it was a turn and burn kind of thing, whatever, just price on the bottom and sell them. Today, they're more conscious of what the market's doing. However, there's still value play there because say we have is there a specific area, John, people buy in on here? Or is it everywhere?
I mean, the Meetup is West Suburban. So, I mean, I
All
personally do a lot of
right.
business, Forest Park, Berwyn, all these areas, LaGrange, Riverside,
Okay,
Oak
so
Park.
we'll use Berwyn for example. Say you have say you have a bungalow in average condition, it's worth 225 today, right? Say that. And our REO, needs a roof, needs this, needs that, but we're going to deduct that. We're going to deduct the repair costs from what the average value was and kind of work our value backwards to come up. And then, of course, we know nobody wants to pay top dollar. Say a house worth 200, it needs 50,000 in repairs. Nobody's going to want to pay 150 to make it a wash. So we have to build some equity in there to make it make sense. So that's kind of how we price stuff out. And there's still value adds there because a lot of people that are buying in these 250 to 450 markets don't have liquidity to do repairs. They have the FHA loan, but the FHA loan won't qualify for a lot of these financing of these as is deals. So there's still value add opportunity there. So I don't know if that helps explain a little bit, John, but
no, it's awesome.
Sorry, can I ask, how about downtown area, relatively downtown, like Lakeview, a little bit north area of Chicago?
talking about the condo market?
Yeah, more like a condo market.
What about it?
Yeah, should we see the value? Do we need to worry about the value right now, or?
I mean, I think downtown River North, the immediate downtown area has seen a slowdown in values, increase in market times due to the surrounding factors that's going on in the city. A lot of people don't want to go downtown right now. I mean, at least I know a lot of people that fear the crime down there. Lakeview, I think, is okay right now. Those markets are still strong. But yeah, I think you're okay on the northwest side of the city, but downtown condo market has softened quite a bit over the past couple of years.
That makes sense. Thank you.
No problem.
Ryan,
Thank you.
Ryan, you also work in some other markets, right? You do deals in other markets, or are you only Chicago based right now?
Only Chicago based right now.
Okay.
We've been asked to go to Jersey and other places, but I mean I know Chicago well, and I don't want to spread myself too thin and go
Totally.
to market that I'm not fully aware of.
And I'm going to open up for questions here in a minute because I like this to be very informal and
Yeah.
conversational with the group. We got a couple, at least one question in the chat. Where do you list your properties? Are they all MLS or do you have a different?
MLS.
Okay, cool.
No,
So
we
everything's
list
hitting
everything.
MLS.
Everything's on the MLS. We don't sell anything off market. I give you my email address. You can send me an email. We'll add you to our list. What we do is we send it out a day or two before we list it to our investors and people that we work with, just to give them kind of heads up on it. The property's got to be on the market for 3 days in the MLS at least. We'll kind of guide you on what we think is the best offer, but again, we can't throw away offers. We can't, do anything unethical. But and if the deal works, it works. If not, there's always going to be another one. So if you do want to email me and get added to that list, my email is ryan@smith, SMITHREO.com.
I'm throwing that in the chat for everybody. So no worries if
Okay.
you missed that.
I had a quick question.
Good.
As far as these 40-year mortgages that were like a hot topic, everybody was talking about them. As far as the banks pretty much giving them out to people in foreclosure. Do you have any insight on that?
No, I don't. The 40-year mortgages, we don't really look at mortgages or loan origination. We focus mainly on notes and default mortgages. I don't know much about what they're originating these days and how it's helping with them. I do know that they've loosened up some credit score guidelines. I know they've loosened up down payment amounts, but I don't know specifics on mortgage terms or anything like that as of today.
Got it.
I have a question somewhat related. Sorry, go ahead.
Yeah, no, go ahead.
Or a little bit earlier, you had mentioned though that one of the things you were thinking was with people exiting forbearance incorrectly, there could be more properties coming on up for sale. Could you explain what that would be? Because I wasn't in forbearance, but my understanding was with the rules of forbearance, essentially, on average, most people would be getting out of it, and the loan, if they exited right, would be tacked on for the payments they missed the end of it. So just I was kind of surprised to hear your statement that you think that there's a possibility that there's still a decent amount of people who don't do it right that would lead to more properties coming up.
Well, there's a lot of people that failed out of the forbearances that didn't qualify. That the point of the forbearance was to put everything on hold for a while. They'd reevaluate them 6-9 months later, a year later, and a lot of people either bought cars, bought TVs, maxed out credit cards, and they weren't qualified to be in the forbearance, or they offered them extended payment plans and they failed out of that. Hold on, I can bring up some numbers for you here in a minute. Let's see here. Initially, in September of this year, 2.1 million homeowners are in forbearance. 6% of those canceled their forbearance. 27% resulted in a loan deferral partial claim. 24% continue to make their monthly payments. 15% of that 2 million did not make any payments at all and exited forbearance without a loss mitigation placement plan. So I mean, there's still 15 to 20% of that 2 million that never successfully completed their forbearance program. And Illinois had one of the highest rates, with 1 in every 5,000 houses in some sort of default as of September this year.
Okay, that makes sense. Thank you.
No problem.
Ryan, there's a good question on the chat here.
Yeah, one of the
Agreed.
questions on the chat was, do you expect the default rate on multifamily to increase? And so since you're in the residential space, maybe you could say like 2 to 4 units. How does
Yeah,
that
I
compare
think,
to single family?
yeah, I look at single family, I combine condo, single family, 2 to 4 units all under the same default numbers. I think we're gonna see, like I said, a 2.5 to 3% steady flow default rate for the next few years of single family 2 to 4 units in condos. I haven't broken them down. We don't break them down by single family or condo only. That's the whole single family realm in that case. Anything over 4 units is considered commercial. We don't really look at commercial at all or focus on commercial in any aspect.
So the answer is yes, there's going to be defaults. For those of you looking at 2 to 4 units, they're coming at a similar percentage rate, it sounds like, based
Yeah,
on what you
and
guys see.
the values on 2 units right now are through the roof. I mean, West Side's, for an as is 2 unit on the West Side, I mean, 160 is a steal, it seems like right now. The values are really high right now, which concerns me again. How high can they get, right? But we will see what inflation does to us.
Can confirm that. I listed a 2 flat on the west side that not-for-profit flipped, and I was blown away with the value. It was over.
Was it
300,000.
rehab?
Yeah,
Was
fully
rehab?
rehabbed.
Yeah. Oh yeah.
FHA. Yeah, unbelievable
300
the
all
value.
day. Yeah.
Yeah. I was very surprised. Obviously, they were happy, but it was a surprise because that wouldn't have been the case a few years ago.
Oh no. I mean, I remember we were selling them as is at 60,000, and that wasn't that long ago. On the as is side. So
Hey, where was that
Whoever
on the
took a
west side
risk.
you speaking about?
anywhere from Augusta to Roosevelt. I mean, even like we just had one over at Maple, 38 Pulaski and Maple, 160 as is. We had one over off of Harrison, 165 as is. Just had one at 420 LeClaire. We priced out at 190 as is. I mean, the whole west side right now, which normally used to only stick to the Austin area, which used to have high values on the west side. But right now, I mean, the whole west side south of Augusta is on fire. I mean, from a value aspect.
Property I was referencing was North Lawndale, just in case anybody was curious. So very good value there.
Yeah.
Who else has some questions for Ryan? You're talking with pretty much the guy doing REOs. So I know a lot of investors get excited about buying foreclosures, and I cut my teeth shopping foreclosures as an agent back in 2015, 2016. Get a new client. That's the first thing we do is go 2 or 5 or 6 of them. Now you can't find one. So the good old
Yeah.
days.
So Ryan, you mentioned that some areas are going to be impacted more than other areas. And I mean, of course, we know some areas are like North Lawndale and Austin that are prone to that. But what other areas that are considered good are more prone to having more foreclosures in the next 3 to 5 years?
You know, I really think the Berwyn-Cicero market, I know a lot of you guys over there is very prone to a correction. The reasoning why is Berwyn and Cicero have some of the highest tax rate increases with the highest FHA buyer pool and the least amount of equity. And, you know, I think properties are trading now in Berwyn and Cicero, Berwyn especially for 475, 500,000 for a 1,200 foot 4-bedroom bungalow. And people have they're putting 3% down, which is coming from the seller on a seller's closing cost. No, I think any markets where you look at limited equity and high property taxes, we're seeing a ton of inventory now in Lansing, Country Club Hills, the south suburbs. Again, high property taxes, right? High property taxes push a lot of these FHA buyers, into trouble. And I think if rates rise, that FHA market's even more prone to a correction because their values are going to drop, and buyers' buying power is a lot less at a 3% mortgage versus a 4%. Instead of affording 475, they afford 425. So now the rehabs are starting to settle, and at the same time, the guy that bought this year in 2 years, his taxes go from 6,500 to 9,500, and it's going to be hard for a lot of these people to make ends meet with the rise in tax and a slight correction. Where if you look at markets such as Clarendon Hills, Downers Grove, Northbrook, Skokie, where you have more equity, people are using more conventional financing. They have 15, 20% down. They can weather a storm a lot easier than somebody that's in a house with no equity and buying at the peak of the market. So I think if you really want to watch those, 250 to 450 single family markets where taxes are prone to continuing to rise.
Ryan, we had another interesting question in the chat. Would you say right now the price gap between REOs and regular market properties is narrower than has been historically?
What's the definition of regular market property? Fixed up, good condition?
Yeah, let's just say your average house.
Yeah, I mean, I think that we're seeing a lot of people overpay on stuff right now because they want to keep their crews busy or they need to keep themselves busy. So a guy that before wouldn't, wanted a 10% margin is okay with a 6% margin or a 5% margin. So I think the market's making the gap less than what it used to be. So yes, we are seeing less of a difference. But I think there's still value add there because, if you're buying the worst house in the best neighborhood, you're going to have more potential to gain equity and you could rent the property out and, allow the market to increase or decrease. It doesn't really matter if you're getting cash flow on it. And it's, like I said, the inflation, you can combat inflation from a rental property.
Ryan, I had a question about kind of tied to inflation, but we're seeing, we know the real estate market is crazy hot, but equally the job market is crazy hot. So somebody who's seen that rise in property taxes can just get a job and work extra hours somewhere. There's a lot of places that are paying low 20s per hour for you to do something.
What job market is hot? Because I can't find anybody to work. It seems like nobody wants to work. So
exactly. That's why right now nobody wants to work.
Yeah.
Amazon's paying 23 in some places, 23 an hour.
Yeah. So in those systems, what you're saying, the job market will combat property tax increase?
Possibly.
Is that what you're asking?
That's basically what I'm asking. Yeah, and all the other increases that go along with property ownership.
I mean, it's like that pendulum though, right? You buy today and you buy at 250 and a year from now it's worth 350, but everything else has went up. Where are you going to use your equity at, right? They're paying more, but is the inflation offsetting their income? Is the property tax are rising, but they're making 22 instead of 16. More money, more problem. I don't know if that's going to be. I don't know. It'll be interesting to see. But you get what I'm saying, though, is everything else rises and income rises a little bit. The taxes aren't going to stay still. Cook County's in a deep hole with property taxes from a commercial and residential standpoint. And I think it's going to have a greater effect on value than people perceive it to be.
Ryan, we had another really interesting question thrown in the chat by Cliff Wilson. Do you have experience with Cook County Land Bank? Are they effective at getting distressed properties off their books? Yeah, I don't know if you work with them or not.
I had lunch today with a friend of mine she's working very closely with the new president of the Land Bank. They had a transition in leadership 3-4 months ago, 2 months ago maybe. And I think they're going to be opening their books up here in the next 6 months and increasing their buyers who they're willing to sell to. So I don't know the new leadership there yet. No, I don't. But they're going to be looking for people to buy here. They have a lot of inventory. They have a lot of properties. I know that. And I think the previous leadership kind of slowed down the funnel a little bit. And I think the new executive team over there is going to want to open it up here this year.
Cool. I know they have a challenging mission. It sounds like it's a little bit of a different space even than you're in. So
yeah, that's a tough job they've got over there. Yeah.
Anybody interested in looking them up? I mean, it's potentially a spot you can find a deal, but I know I did a little bit of research on it. It seemed like, there's going to be some tough properties that come through there. but it's an
Yeah, they-
admirable idea. That's for sure.
Yeah. There's another land bank. Out
They
in
have a
DuPage
website from
County.
1996.
Is their website that old? Is it that
No,
bad?
I'm making that up, but I mean, it is remarkable trying to interact with it.
Yeah, they had a lot of technology and leadership holdups, I think, over the past few years. But I think it's getting worked out now, and they have a new path in mind. So I think they'll be good.
I interrupted
Hey,
you. You
Ryan.
were about to mention a different site that's similar.
I think they also have a DuPage County land bank also. My partner had lunch with them about 9 months ago. I forget. John, I'll email you. I'll get with him and I'll email you the info on that. But it's very similar for DuPage County in the western suburbs.
Awesome.
I'll email
I-
you that info tonight or tomorrow so you can update the chat.
Very cool. Hey, we had a guest, little fly in the wall, Mark Ainley. Ryan,
I
great
saw that.
presentation. What do you think the next Chicago mayor has to do to stimulate commercial growth in the south and west side of Chicago?
Mark, it was a topic at my lunch today too. Also, I think that it came up to the people I had lunch with had very good points, and they said it has to go back to the old daily ways, and I say that in meaning block parties, block clubs, and caps have to be involved in the community. And I think we've lost that in the past few years. Having a dedicated caps for every neighborhood. If you guys are aware of what caps is, Chicago Action Police, it's a community action police committee where the community is tied in with the police department, and each caps has a direct liaison to the police department, kind of like a precinct captain for the neighborhood. I think you have to involve the neighborhoods a lot more and make them feel like the city supports the neighborhoods and make the city feel like they have trust of upper executive management and that they can count on them. And I think that'll be a big help of reducing crime. I think crime's the reason a lot of people don't want to go to the city right now. And crime is, people don't feel safe. I think you have to get safety back in the city before anything else.
So Ryan Smith for mayor, you heard it here first. No, just joking. Just joking. Who has more questions for Ryan? Good opportunity to kind of pick his brain here.
Hey, Ryan, this is Alex Martinez. Had a quick question for you about the general timeline from foreclosure to hitting the market. I know I've seen a couple properties I've been interested in owned by foreclosure recorded, owned by Fannie Mae, but they're a couple years old now. So just kind of wondering if there's how long that typically takes and if that's guaranteed to hit the market. Is there any way to access shadow inventory, anything along those lines?
When you ask how long, are you asking from the time somebody misses their first payments? Or the
No,
time
I'm asking-
foreclosure is filed?
Foreclosure is filed and that's been recorded.
Typically 6 to 9 months before it goes to sale from the date foreclosure's been filed, from the date of foreclosure judgment's been filed, 6 to 9 months before it goes to sale. Now, those timelines have gotten real skewed in the past year and a half because of backlog and because of courts being shut down. But prior to, typically they'd have to miss payments for 2 to 3 years, get a forcible foreclosure, and then 6 to 9 months after that, it would go to sale. And then if it was vacant at sale and reverted back to the bank, probably 90 to 120 days before you saw it on the market. So from foreclosure, 6 to 9 months. The data reverts at sale, 60 to 90 days, and about 120 days from foreclosure sale date to market if it's vacant. If it's occupied, that can take up to 2 to 3 years before you get them out, depending on how smart they are and how well they know the game and they know how to play the game. So I mean, those timelines are very case by case basis, but in a perfect world, it should take 9 months before it gets to sale and another 3 months before it hits the market.
Okay, so something that's been foreclosed on for a couple of years now, definitely it's got something going on with the tenants in there or something else that's delaying things.
Yeah. Has it went to the sale?
I'm not positive. I'm just looking on the county records and I see a foreclosure document recorded in December 2019. That's all it shows.
If you want to email me the property address, I'll try to look at it for you. But typically, well, if it's a Fannie or Freddie, they stopped all foreclosure proceedings at COVID and they haven't picked back up yet. So Fannie and Freddie are still kind of very conservative on what they're foreclosing on. But I mean, if you want to email me the address, I'll take a look at it for you.
Okay, thank you.
No problem.
We had another.
Ryan,
Oh,
go ahead.
Go ahead.
Oh, I was just going to ask. So, all of these the foreclosures, they're all legal proceedings. Is there a way to get a list of these foreclosures that are going on?
I don't even know. I mean, I don't even have a list of them. I mean, I'm sure pro bidders. I use pro bidder a lot to look at what's going to sale and what's not going to sale. Pro bidder is a great site to use, and that's probably your best bet. Pro bidder. It's a membership based site, but they should have information on there on how to sign up and get an account and all that. But probidder.com they track all sales and they tell you when the sale date is. They tell you what the balance is. That's probably your best site to track stuff on.
We had another question in the chat that I think I want to get out there from Barsh. Can you elaborate more on the negative equity in Chicago being higher than any other major city, but is that factoring in all the value increases?
Sure.
Also, where can we see that data? Is it public or is it just something that's proprietary?
I mean, they run a story on it about once I mean, they run a story on it every year in Cranes and the Tribune. You can just Google negative equity real estate market in Chicago. I did a presentation in September at a national conference. At the time, we had 160,000 households seriously underwater in Chicago market alone. That's Chicago proper. 160,000 households seriously underwater. Seriously underwater is defined as homeowners that owe 25% or more than their home is worth in today's market. That equates to about 8.6%, which is the highest of any large metro area. We've only have about 18.4% homeowners that have at least 25% or more equity in their home in the Chicago market. So in those stats, I think I pulled from, Cranes did an article on it. The Cranes runs an article every year on the equity problems we see in Chicago. And just to give you an idea, 85,000 homeowners refinanced the first quarter of 2021 alone. Last time we saw refinance numbers that high was in 2004 when 92,000 homes refinanced in the first quarter of 2024. Why that's something to be concerned of is what are people refinancing for? They're taking home equity out of their home. Money's cheap, values are high, right? You have a high number of refinances. You have a lot of people saying, "Oh, there's 80,000. Let me take more money out, more money out, more money out." So that's another thing to kind of watch how many refinances are happening within the Chicago market with values going up, and that's why we still have a large underwater market right now because people are refinancing their homes, taking money out every chance they get, and they're buying with FHA loans and they don't have a lot of equity to start with. It's not like they have 20% in and they're taking another 10% against it. So I hope that answers your question on serious underwater numbers.
We had another question from Mark Ainley. Is the sheriff or judicial sale any volume daily or weekly basis? Are the courts and moratorium still slowing down the process? I think I just read that right.
We saw a huge increase in volume in December and January. Right now, we're seeing a slight slowdown for some reason. I don't know why. For example, last week there were 68 properties that went REO last week of January. The first week of January, there were 240 that went REO. So I mean, we've seen quite a drop off. I'm not sure as why. I think we had a huge rush in September of filings because we were first finally able to file. And I think we worked through a lot of the backlogs when the courts opened. I think we're going to see a little lull here for the next couple weeks, but filings are up huge on the foreclosure firm side. And I think we should see the inventory back to increase. I'll try to see how many sales are going in February for you. I hope that answered your question, Mark. But
Ryan, nobody asked this question yet, but I feel like it's kind of apropos to another one that's in the chat. But the stuff that you're seeing come through, is this still pre-COVID foreclosures? Is this still stuff from, early 2020, late 2019, or is this new stuff from?
no, we
2021?
have no. This is all pre-COVID. We haven't seen a lot of the COVID stuff come through yet.
So that's still coming, and like you said, 9 months to a year, really. So
Yeah, I don't think we'll see any of that for quite some time.
that's next year, even maybe, right?
Yeah.
2023 potentially.
Yeah.
We'll see some of that stuff hit.
Yeah, Q3, I think we'll start to really see that stuff come out. Yeah, probably third quarter.
So I think that answers. I know John Hernandez in the chat had a question about the REO market. Feel like there's a couple of markets that are similar. I hate to say evictions and REOs are similar, but everything that was held up by the courts really has barely started, is what it seems like, and things are just
It's
starting to
barely
get rolling
started.
again.
Yeah, I mean, in February alone, there was 944 properties going to sale in February. That's not a huge month. I think in December we had like 1,600. If we look through the end of March, sorry, I'm just trying to. If we look through the end of March, we'll see about 1,500 properties go to sale from now through March. So about 750 a month on average are going to sale, and probably 30% of that comes REO. So out of that 1,500, it's probably 500 REO, give or take.
So can I ask a question?
Yeah.
So you're saying at the judicial sale, I guess you're speaking about the judicial sale, 30% is going back to the bank, and the other 70% they're bidding pretty good down there? I haven't been down there in a while.
Yeah. People are buying. Yeah, people are paying astronomical numbers at the sale right now.
Is it companies, or is it? Do you think it's companies or individuals?
No, I think it's a lot of individuals. I think it's a lot of people that are just they're strapped for inventory, so they're overpaying, and they think the market's going to keep rising. And like I said, people want to keep their crews busy. I hear that more often than not. I just got to keep my crews busy. I'll rent it. I'm not worried about if I can't sell it, but I don't want to lose my good guys. So like I said, people that would want a 10 to 12% return on a property 2-3 years ago are okay with a 4 to 6% return today. Just so they don't lose guys and they stay busy. And if they can't sell, they'll turn it into a rental. But people are paying high numbers at the sale, real high numbers. I think there was a bungalow in Cicero that went for 190 last week at the sale, occupied. We're seeing more occupied properties revert back to REO because people don't want to take on the eviction, headaches and timelines with that in Cook County. So, which is fine with us.
So I've been out the game since like 2008 when it crashed. So I haven't done any rehabs at all. How is the material affecting you guys? Affecting buying material? Are they triple? I know you talk about inflation.
Yeah, I mean, I don't rehab a lot of houses. So I don't, we sell a lot of our stuff as is, and I really don't represent a lot of investors on the back end side of there. So I'm not sure how it's affected it. I think it's, like everything, values rise on houses, so it can offset the construction costs, but they're not getting the 10 to 12%. You're not going to do a $30,000 rehab on a single family home anymore.
Mm-hmm.
I mean, your rehab numbers are going to be more 60, 70,000 on a single family ranch, right? But then again, your back end values go up, right? So it kind of washes it all out. But I do know prices are high right now on that stuff.
Right, how much do you guys deal with the eviction process when you have tenants in place in these properties? Is that something you guys have to get involved with a lot?
Yeah, I mean, right now, probably 40% of our portfolio is occupied. So yeah, I mean, we deal with cash for keys and evictions every day. Evictions are slower. It's odd. In September, October, November, we were doing about 2 to 3 evictions a week. And then it's kind of slowed down. And we had the holidays and temperatures are cold. So, on a day like today, if you had an eviction scheduled, the weather saved them. They won't do an eviction on a day like today or tomorrow, right? The weather's got to be above 30 degrees. And can't be snow and things like that. But sheriffs are doing evictions again. We're seeing a lot of them. Yeah, I mean, they're happening. It's just the backlog was astronomical. I think they're seeing 500 to 700 filings a day for evictions down there, where prior to COVID, the average was 350, 400. So, I mean, they've seen quite an increase of filings every day in the courthouse.
We had a fun question in the chat again from Mark Ainley. What's the largest cash for keys check you've ever seen a bank cut?
Right, 15,000, 20,000. Yeah, 15, 20,000.
So it pays to be a really, really bad tenant during a foreclosure. I don't want to say that in the recording. We'll cut that out.
It pays to have a high value asset to be a bad tenant. Or it pays to be a tenant in Cook County. I mean, we've done a lot of KCRO checks, 10-6, 10-6 on, we've given 10-6 out many times on 2 units on the south side or west side. KCRO is phenomenal for tenants, and I'm not sure. KCRO is keeping Chicago rent set ordinance. It applies to foreclosure properties with tenants in place. So if a landlord goes into foreclosure and they have tenants in place, the bank's required to either extend their lease at fair market value or give them $10,600 per unit for the tenants to vacate. And if they don't offer it, there's fines in excess of 30 to 40,000 per unit to the bank. So, I mean, we do probably 1 to 2 KCRO cash for keys a month.
Probably better for those tenants if the landlord went into foreclosure was probably a bad spot anyway. So it's a good way to get back on your feet.
Right.
That's awesome. So I want to be respectful of Ryan's time. We're kind of rounding out here in the last couple minutes. Does anybody have any final questions for Ryan before we close out for tonight? Oh, here we go. Here's a really good question about cash for keys. If 15 to 20K is the high, what's a typical cash for keys that you see? 2 to 3K more?
Yeah, 3 to 5. I mean, our average is probably 3,500. Probably 3,500, 30-day vacate. 3 to 5,000 is our average. That's very common.
Cool.
At what point in the process, if someone starts paying their monthly payments, can they get back on track and not get foreclosed on?
That's all I'm not, that's a servicing question. That's
okay.
That depends on their loss mid plan, and by the time it comes to me, by the time it even goes to
that.
Yeah, by the time they have a foreclosure sale dated, the Cook County sale, I mean, it's past that. But look, it's if they stay in contact with their loss mid department or their servicer, they can play the game for a couple of years. Make 2 payments, fall off, and make 2 payments 9 months later and fall. I mean, they can play that game for a couple of years.
Okay.
Well, can I say this? Most of the time, the banks want the money all up front. I mean, they want the full balance when you get so far in debt like that.
Yeah, that's, I think it's, that's also, or they want a good down payment and refinance. I mean, it all really depends on the case by case scenario. But yeah, I'm not sure that's not really my realm.
Awesome. Well, thank you so much, Ryan. This has been incredibly helpful to the audience, and audience, thank you for all the really great questions.